Ladies and gentlemen, stop what you're doing. Bitcoin just did something it hasn't done in 4 years. The price dropped below a threshold that was supposed to hold. That's the headline. That's what you'll read everywhere. But that's not the story. The story is what happened in the 12 hours before the drop. The story is what didn't appear in the order books. The story is why every major exchange saw liquidity vanish at the exact same moment, in the exact same way, at the exact same price level. This wasn't a crash. This was a controlled demolition. Let me walk you through what actually happened. Bitcoin was trading at 68,000. Stable. Volume normal. Nothing unusual. Then at 2:17 in the morning, Eastern Time, something changed. The bid walls disappeared. Not slowly, not gradually, all at once. $70 million in buy orders pulled from Coinbase. $90 million from Binance. $40 million from Kraken. Gone. In less than 90 seconds. You don't see that kind of coordination by accident. Within 6 minutes, Bitcoin dropped to 62,000. The velocity wasn't normal. This wasn't panic selling. This was systematic. Every bounce got sold into. Every recovery attempt met with fresh supply. And here's what makes this different from every other drop you've seen. The selling wasn't coming from retail wallets. It wasn't coming from the usual panic. It was coming from wallets that hadn't moved in years. Wallets holding 10,000 coins, 20,000 coins. Wallets that looked dead suddenly came alive all at once, all selling. Someone gave the signal. Now here's where the narrative starts to fracture. The media will tell you this was inevitable. They'll say Bitcoin was overvalued. They'll point to regulatory pressure, to interest rates, to risk-off sentiment. And sure, those factors exist, but those factors existed last week. They existed last month. Why now? Why this specific moment? Why this specific coordination? Because something changed behind the scenes that you're not being told about. Let me give you the context they're leaving out. 3 weeks ago, the Treasury Department announced a new framework for digital asset reporting. Boring headline. Nobody paid attention. But buried in that framework was a clause about custodial accountability. What it means in plain language is this. Any institution holding Bitcoin on behalf of clients now has to prove they actually have it. Not on paper, not in accounting entries. Physically provable on-chain reserves. And they have 90 days to comply. That deadline is 62 days away. Now think about what that means. Think about the banks that offered Bitcoin exposure through ETFs, through structured products, through derivatives. Think about how many of those products were backed by actual Bitcoin versus how many were backed by promises. Paper Bitcoin, synthetic exposure, fractional reserves. And now they have 2 months to prove it's real or face criminal liability. This is where the math stops working. Here's what we know. The total Bitcoin supply is 19.6 million coins. Of that, roughly 4 million are considered lost. 14% never moving. While it's inaccessible, keys gone forever. That leaves 15.6 million in circulation. But when you add up all the Bitcoin that's supposed to exist across exchanges, ETFs, corporate treasuries, and institutional products, the number comes to 18.3 million coins. Someone printed 3 million Bitcoin that don't exist. And now they have 62 days to find them. This is why the selling started. This is why it's not stopping. Because the institutions that sold you Bitcoin exposure never bought the Bitcoin. They sold you a receipt. And now the government is asking to see the warehouse. And the warehouse is empty. You're watching the unwinding happen in real time. Let me show you how this plays out. Right now, Bitcoin is at 62,000. The institutions that need to cover their short positions, the ones that sold paper Bitcoin they never owned, they need to buy real Bitcoin to fill the gap. That should push the price up, right? That's how covering works. Except it's not happening. The price is dropping, which means one of two things. Either they're not covering, or someone bigger is selling into every buy attempt to prevent the price from running. Either scenario is catastrophic. If they're not covering, it means they've accepted they can't. It means they're going to default. It means the ETFs, the funds, the products that promised Bitcoin exposure are about to announce they don't have the assets. That's a Lehman moment for crypto. That's every holder realizing their coins might not be real. That's a run on every exchange simultaneously. If someone is suppressing the price while they try to cover it, means there's a coordinated effort to acquire millions of Bitcoin without moving the market. That requires selling pressure from an entity large enough to absorb institutional buy-side demand. There are only 3 players with that capability: the US government, China, or a coalition of central banks acting through intermediaries. Any of those options means Bitcoin's price is no longer set by the market. Let's talk about what happens next. The 62,000 level just broke. Next support is 58,000. If that breaks, it's 50,000. These aren't just psychological levels. These are margin liquidation cascades. Every long position leveraged above these levels gets automatically sold. Every futures contract gets unwound. The selling creates more selling. The velocity increases. This is how you get to 40,000 in a week. This is how you get to 20,000 in a month. But here's the part that should terrify you. Let's say they manage to contain this. Let's say the institutions somehow acquire enough Bitcoin to meet the regulatory requirements. Let's say the price stabilizes. What do you think happens to the narrative around Bitcoin after that? It was supposed to be decentralized. It was supposed to be outside government control. It was supposed to be the escape from the traditional system. And it just got bailed out by the same institutions it was designed to replace. The trust breaks. The ideology breaks. And without the ideology, Bitcoin is just a speculative asset with no cash flow, no earnings, no intrinsic value. It's a collective belief system. And belief systems collapse when the believers lose faith. Now let me show you the timeline they're not discussing. This drop happened 48 hours after the largest Bitcoin mining operation in North America announced they were halting expansion. They cited energy costs, but energy costs didn't suddenly spike this week. What changed was their financing. 3 of the largest mining companies just had their credit lines pulled. Not reduced, pulled, completely. Banks are cutting exposure to the entire sector. That doesn't happen unless someone knows something. That doesn't happen unless there's a directive from higher up the chain. Because here's the thing about Bitcoin mining. It's the backbone of the network. It's what processes transactions, secures the blockchain, maintains the system. If mining becomes unprofitable, if operations shut down, the network slows. Confirmation times increase, transaction costs spike, and the user experience degrades. You ever try to use something that takes 6 hours to process a payment? You stop using it. And here's the second order effect nobody's pricing in. Bitcoin's narrative strength has always been its resistance to government control. You can't freeze a Bitcoin wallet the way you freeze a bank account. You can't seize Bitcoin without the private keys. Except that's not entirely true anymore. Because the on-ramps and off-ramps, the exchanges where you convert Bitcoin to dollars, those are fully regulated. Those are fully monitored. Those have KYC requirements, transaction limits, and government reporting. You can't freeze the Bitcoin, but you can freeze your ability to use it. And once people realize that Bitcoin only works if you can convert it to fiat, once they realize the exit points are controlled, the whole decentralization argument falls apart. You're not holding an independent asset. You're holding a token that requires government permission to spend. And if that's the case, why not just hold dollars? This is the psychological break that's starting. This is the moment where people ask, what am I actually holding? Let me give you the scenario that keeps the smart money up at night. Bitcoin drops to 40,000. Institutions default on their obligations. The SEC launches investigations. Class action lawsuits get filed. Exchanges freeze withdrawals during the chaos. And while everyone's focused on the price, quietly, legislation gets passed that requires all Bitcoin transactions above $10,000 to be pre-approved by financial authorities. It gets sold as consumer protection. It gets sold as anti-money laundering. It gets sold as national security. And just like that, Bitcoin becomes a monitored, controlled, government-approved digital ledger. Everything it was designed not to be. You think that's far-fetched? That's already happening in 5 countries. The framework already exists. It's just waiting for the crisis that justifies implementation. And this crash might be that crisis. Now here's the really ugly part. Let's say I'm wrong. Let's say Bitcoin recovers. Let's say it bounces back to 70,000, 80,000, 100,000. That doesn't mean the problem went away. That means the problem got papered over. That means the institutions found a way to hide the missing coins for another cycle. That means the fraud got bigger, the exposure got deeper, and the eventual reckoning got worse. Because here's the fundamental issue. Bitcoin's market cap is $1.2 trillion. But the actual liquid market, the coins that trade, the coins available for sale at any given time, that's maybe 200 billion. Everything else is held long-term, locked in wallets, staked, or inaccessible, which means the price is set by a tiny fraction of the total supply. And if institutional demand tries to buy even 10% of the float all at once, there's not enough supply. The price would have to go exponential. We're talking 200,000, 300,000 higher. But that's not happening. The price is dropping while institutions supposedly need to buy, which means they're either not buying or the coins they need don't exist. Let me paint the end game. Bitcoin goes to 20,000, then 15, then 10. Retail holders capitulate. The institutions that survive buy the bottom. Regulations get passed that make Bitcoin unusable for anything except approved transactions. The blockchain becomes a government-monitored settlement layer. And the people who believed in financial freedom realize they've been holding a Trojan horse. Or maybe it doesn't go that way. Maybe Bitcoin stabilizes at 50,000. Maybe the institutions quietly cover their positions over 12 months. Maybe nobody notices the coins that appeared out of thin air. Maybe the system holds together. But either way, something broke. Either way, the trust fractured. Either way, we just watched the moment where Bitcoin stopped being an alternative to the system and became another instrument controlled by it. And once you see that, you can't unsee it. The price will do what the price does. That's not the story. The story is what this revealed. The story is how fast the infrastructure folded under the first real pressure. The story is how easily the decentralization narrative collapsed when the institutions needed it to. You're not watching a dip. You're watching the end of a belief system in real time. And belief systems don't come back once they break. They just get replaced by the next narrative, the next promise, the next thing people are told will set them free. Let me show you what's happening right now that confirms this. Over the past 72 hours, Bitcoin wallet addresses holding more than 1,000 coins have decreased by 8%. That's not normal distribution. That's not profit taking. That's capitulation from the holder class that was supposed to never sell. The wallets that accumulated during the $20,000 range, the $30,000 range, the ones that held through every previous correction, they're exiting. Why would they exit now unless they know something you don't? The coins aren't going to exchanges. They're moving to new addresses. Fresh wallets, no transaction history. This isn't selling. This is repositioning. Someone is consolidating Bitcoin into clean addresses while the price drops. That's not panic. That's preparation. Let me give you the theory nobody wants to say out loud. What if this entire drop is intentional? What if the goal isn't to destroy Bitcoin, but to reset it? Retail gets wiped out. Weak hands capitulate. Institutions buy the bottom. And when it recovers, well, the ownership structure has completely changed. Bitcoin becomes institutionally controlled. The decentralization was always temporary. This is the transfer. Now connect this to the traditional markets. Treasury yields spiking, dollar strengthening, risk assets selling off, gold holding, but crypto collapsing. Why? Because when liquidity tightens, the assets with no intrinsic value get sold first. Bitcoin produces nothing, no cash flow, no book value. It exists as a store of belief, and belief evaporates when people need actual money. Here's what should make you pause. Every crypto correction over the past 10 years has been followed by new all-time highs. That pattern has trained an entire generation to buy the fear, but patterns break. And they break when everyone believes they're permanent. What if this time is actually different? The people positioning right now, the ones moving coins into fresh wallets, the ones pulling liquidity, they're acting like they believe it will be. Let me give you the tell everyone's ignoring. Tether just announced they're limiting redemptions to institutional clients only. Retail holders can't convert Tether to dollars directly anymore. They have to go through exchanges, and exchanges have withdrawal limits that can be changed at any time. You're holding an asset you think you can exit. But the exit requires converting to Tether, and Tether requires institutional approval to convert to dollars. You're holding a token that requires permission to spend. That's not freedom. That's a controlled system with extra steps. And the final piece. The Bitcoin hash rate just dropped 11% in 1 week. Miners are shutting down. Not profitable at 60,000 with current energy costs. If the price goes to 40,000, another 20% of miners go offline. The network slows, transaction fees spike, the user experience becomes unbearable. This is how adoption dies. Not with a ban, not with a headline, with slow degradation of utility until people just stop using it.